Hi guys, Andrew Cross here with Andrew Buys Homes. We're over here looking at another one of our rehabs that we just bought and we just started working on. We've got Brighton here.
Hey guys, I'm Brighton. I'm with Stout Lending, investor-friendly mortgage brokerage here in Oklahoma City, and we're just here doing a walkthrough with Andrew, taking a look at his projects.
Yeah, so I'm super excited right now. We are, today at lunch, we are actually going to go meet with one of our big bankers, and we're working on a big cash out refi. So all those little houses and stuff that you've seen over the last couple weeks, we are getting ready to just go grab all those and refi them and pull out all those investor cash. So just to give you a little recap on how we buy houses and what we do. Most of the time we're using private money. I'm using, so I've got a couple private people that loan me money, and then we use some bank financing. The problem is my bank only loans me up to a certain amount for purchases. So now I've got to go find somebody like this guy here, and I got to go get all my refis done. So the 11-plex that we just bought, we're working on getting refinancing for that one. And this one here, I'm debating about what we're going to do with this property. So this property here is a 3-bed, 2-bath, 2-car garage. I think it's going to ARV about $250 if I flip it all the way nice. So that's one option I have here, so I can finish flipping this house, and it's got a bunch of foundation issues. So that's option one. Option two is to go in here and to hotel it. So that's what I'm going to try. I'm thinking about trying right now. It's going to depend on this banker today and find out what he tells us. So I'm going to, that's option two. My best option is to keep it as a rental. Buy and hold is my ultimate game, and I'm trying to buy as many properties as possible. So Brighton and I, go ahead, pull out your handy dandy phone there that we had earlier. So we were debating that, we were talking about a cash out refi on this one. So if we do,
so if this property appraises for $220,000, we could potentially
always go a little lower. I always count I don't count the top comps.
Yep. So always estimate conservatively on your numbers. That way you can account for any what ifs or any problems that occur. So based on this appraising and a conservative value of $220,000 after repairs, he could do a cash out refinance up to 80% of that value, which is $176,000. And do you know what your payoff on the loan would be for this?
My payoff on the loan would be $130,000.
About $130,000 payoff, which leaves there $46,000 for profit margin.
But I still got to do the repair. If I did it, I still need to do the repair, so probably it'd be 10. So there's still possibility to pull out $30,000 in profit on this. Now you said how much was the loan?
It'd be $176,000.
$176,000. And 4.5% interest is what you were saying?
Yeah, about 4.5% interest.
And that was on a 30-year?
Yep, 30-year loan.
So that works out to, you see that? So guys, this is really this simple. This is what I do for all my loans. I just download this simple amortization app, pull it out, and then you can do a little bit more calculations on it. It's got an ad at the bottom. I don't pay for the expensive one that gives me all the extra details, but this gives me an idea of what I'm looking at on this property. So on this, it's about $900 a month. Let's just figure another, so 9, 10, 11, $200 on taxes, $200 on insurance. So what is that, $1,300 a month?
Yeah.
$1,300 a month. We can rent this thing out for at least $1,500, but probably more like $1,900. So it's not my typical 2% deal, but it still would cash flow.
Yeah.
So now the other one you were saying was the interest only, right?
Yes.
And then what would that be? Was that an 80% cash out as well?
So yeah, the 80% cash out on interest only payments for fixed for 5, 7, or 10 years. And what that would do is allow you to have a bank-like interest rate and only pay the interest portion of the payment every month, which will increase your monthly cash flow and allow you to max cash out on your equity. So you can use that cash out to purchase more rental properties, keep your monthly expenses low while you're growing your rental portfolio, and continue growing.
So I did it at 99 years. Would that be just a general idea of like?
Yeah, that sounds about right. So how I usually do it is I take the loan amount, I multiply it by the percentage rate for, typically we estimate 5.5% interest, and then you divide that over a 12-month period, and then that would show you what your monthly payment looks like.
So it's a 5.5% interest?
Yep, let's estimate about 5.5% if it's fixed for 10 years, so you're looking at $810 a month, roughly. So
versus the other one was
it's about closer to $900 a month.
$900 a month, extra
Yeah.
$100 a month.
So what I've noticed on amortizing loans, and some of you may already know this, but you don't actually start to see the principal loan amount getting paid down until about year 10 to 15. And so what this looks like is you're actually going to be able to maximize your cash flow for that first up to 10 years while you're continuing to grow your portfolio while not paying the principal portion of the payment down.
Yeah.
And so you save that little portion of money, because in reality, as you're growing your portfolio, you're not really going to see that principal loan amount shrink as much until, like we said, year 10 to 15.
Gotcha. Gotcha. So most of my loans that I have right now are on about 15-year notes, but that's because they are cheaper houses. So once you get into like these nicer, more expensive houses, the way that you get those to cash flow is by stretching out your years.
Yep.
So you can go on a 30-year versus a 15-year note. So this particular house, I'm still 50-50 on. I'm still going to wait to talk to the banker today and look at a couple things. But either this week, I'm either going to list this house, which is really honestly where I'm leaning towards. Go ahead and just pull out I'll probably make, what, $30,000, $40,000 on it that way, if that, or whatever. So we're just going to go ahead and hotel that. So the other problem with this house is I have a short-term loan on this. So I have a private loan on this piece of property. I gave one of my private guys, let me see, what is his terms? We're paying 10% interest right now, and then I pay 2 points. But on these loans that I get from him, I don't pay any payments. So it just sort of goes into the loan gets bigger and bigger and bigger until I pay it off. So that's one of the reasons I'm able to flip so many properties and do so much, because I don't have anything out of pocket on this property except for utilities. So it can sit here for a month if it needs to, or whatever needs to happen to it, and I don't have to. That loan doesn't mature for a year, so I have 12 months to do something with this property. So 12 months, no payments. He's not worried about it because he doesn't want to calculate all those monthly payments. He doesn't want to have to cash all those checks. He doesn't want to have to do all that. He just wants his money to grow because it's in his retirement account. So anyway, that's how we finance this particular deal. A lot of times my favorite is John Day over at First Security. They're one of my favorite banks to work with because they charge me a lot less points. It's only 1 point, and they can, it's like 1 point, and it's only 6%, 5.5, something like that, percent interest rate on the loans there. And they automatically roll into a rental loan. So that way I don't have to call this guy every single time I want to go buy a house or I go get a loan or whatever and have to do all the transfers.
So do you want me to elaborate a little bit about what's different from this guy versus John Day money?
Oh yeah, go ahead.
All right, so there's a big difference between working with a traditional local bank and a mortgage broker, which is what I am. A mortgage broker, we shop lenders. We have about 50 different options to choose from, and we have everything from local banks to private and hard money lenders to national lenders and just about everything in between. We can finance things from fix and flip loans to portfolio refinance loans to commercial developments and just about everything in between. But being a mortgage broker, we are actually able to work with the clients. Like I said earlier, we're an investor-friendly brokerage, so I myself am an active real estate investor. I do flips and rentals myself, and so what I'm able to do is help investors analyze deals, figure out the right loan product, whether it fits best with a local bank or private lender, and then we kind of let our clients choose from there if there's multiple options to choose from. Sometimes there's only one lender to fit a specific deal in, and so we'll have to choose that lender or not do the deal. But that's mainly the big difference between working with a broker and a lender is you have a lot more options to choose from. Banks have a small box to fit in. We have quite a big box to choose from. So
well, they have more boxes.
More boxes.
The they have a lot. They still have to put it in the boxes. But the nice thing is I mean, one of our properties, you're like, the banker doesn't like that side of town. I'm not going to know that until I go through the entire loan process and all that good stuff, and then I'm going to come back. The 11plex I got a guy looking at right now, they're only going to give me a 70% cash out refi, and I was looking for an 80% cash out refi. Right. And he's like, oh, age of the property. Well, it took me almost, 3 weeks to get that answer back from him. So with a mortgage broker, it's nice because he gets told know a lot more than I do. And I get told no all the time. You just have to continue to go find those banks and go find those relationships. Yep. And they'll say, some banks don't like the under $70,000 ones. Some people do. And it's sort of, from my business, it's sort of awful because most of my houses are in those lower price range. So most people don't like to work with us. So most people or most banks don't like our type of loans. They have to do something else. I don't understand. I'm not a banker. I just like their money. So
I guess to simplify, what he's saying is that certain properties fit with certain lenders and other properties fit with other lenders. There's always a different box for a different type of property value, you know, whether it's a multifamily property or single family, stuff like that.
Absolutely. And then banks are also relationship based. So, you know, you have to build that relationship over time, which I get to tap into his relationship right now. He already has a relationship with this bank. I have a relationship with Brighton, so we can automatically step into that relationship with hopefully, please, dear God, we get to step into this bank relationship today and get some traction there for some of these refis that we're working on. So if not, I have plan A, I got plan B, C, D, and E. So I have actually 4 bankers right now that we're working on with trying to get just quotes. Just go out there and shop banks. One thing you have to realize about banks is they need us. Like, they do not survive. Brighton doesn't eat if I don't buy houses and if he doesn't make loans.
Correct.
And the banker's the same way. If they're not making loans, they're not eating. So it's very important to keep bankers going, but at the same side, they got to make sure they get their return on investment or else they go bankrupt. So, you know, it's all about that relationship. I know John, I've built a relationship with him over the years. The El Reno properties, he funds those. He doesn't lend in El Reno. You know, and it took one phone call, be like, would you for me? And he said yes. So
I had that same situation happen earlier this year. I bought a property out in Shawnee, and I actually reached out to John Day. They said, we don't lend out in Shawnee. I said, that's great. I found another local bank. They also didn't lend out in Shawnee, but they made an exception for me because I had a prior relationship with them. And so that's how far a relationship with a good banker can go.
Absolutely. So when you're going out and you're looking for loans for your property, or you want to go look for stuff, just because they say no today doesn't mean no forever. And also, when it comes to private money, you know, we borrow a lot of money from a lot of private individuals, and it'll always get me. I remember the first loan we did a flip over here in Northwest 39th, and it was in a mentor group or whatever, and the lady, I was like, I got to find money for this, and she goes, oh, I've got money. She lent me the money. It was all the money she had in this IRA that she had. And so we did a deal with her and flipped it. And what do you know? Next thing I know, she's got more money. And next thing I know, she's got more money and more money. And at one point in time, this particular lady, I think we had $500,000 worth of money. But then once you start getting that return on investment and they start seeing what they're getting in the stock market, they start seeing what they're getting with you, they'll roll it over that direction. Then come to find out this particular lady's parents end up selling some rental properties because they realized they were getting a better return loaning me money than they were on the rental properties. So it works great.
If anyone has an IRA sitting there collecting 6% return, then we are happy to pay you 10 to 12. I'm up to 15% return for my private investors.
Ooh, man, you're paying good. I'm usually 10 to 12, and I'll usually pay a point. But then I usually, here lately, I've had a lot of people that just don't want to mess with the turnover or the fact that they want that consistent money. So I've actually been just borrowing the money in the business. And so that way I've got that cash on hand. And it's really nice to go when I know that I can go close on the house cash. I don't have to go ask for permission. I don't have to ask 5 different people. And the thing about private people also is once they start loaning out money, they'll start loaning it out to other people, or you'll borrow up all their money. And that was my problem.
They get
tapped out. So I've tapped out both of my hard money lenders right now that might usually use. And so now I'm having to go to my 3rd and 4th and 5th tier people that I usually don't like to borrow money from because they're more expensive. So that's the pros and cons there.
All right. Well, that sounds like we've just about wrapped that up. You want to go take a look in the house?
All right, let's do it.